Imagine realizing your flagship apparel brand, a brand that has literally defined youth culture for decades, is suddenly just completely disconnected from that very culture.
Yeah, it's a nightmare scenario.
Right. Sales are sliding, inventory is piling up in warehouses, and the only possible way to save the brand's cultural relevance is to fundamentally break how your company operates.
Rebuild it from scratch.
Exactly. You have to design, manufacture, and ship a brand new shoe in exactly 77 days. So today, we are tearing into the Q4 2026 earnings of VF Corporation to see how they are rewiring a legacy behemoth from the inside out.
It is honestly an incredible pressure test of corporate agility. I mean, we were talking about the parent company behind the North Face, Vans, Timberland, and Altra.
Massive brands.
Huge. This is a massive, highly complex holding company that has been, trapped in a really difficult operational slog for years.
Yeah.
Turning around a software company is one thing, right? You just push a code update to a server. But turning around a global apparel conglomerate means you're trying to change the physical movement of thousands of tons of rubber, canvas, and fleece across oceans.
All while trying to predict the incredibly fickle tastes of the global consumer.
Exactly.
Well, welcome to today's deep dive. We are operating under our special Talk Tickers format. So for you, the retail investor tuning in, our mission is to cut straight through the corporate gloss and break down this VF Corporation ticker symbol, VFC earnings call.
We are dropping the PR speak today.
Completely. We are bringing you the data-forward, opinionated, and highly actionable insights you need to understand what is actually happening beneath the surface of this stock. Because looking at this turnaround attempt, the narrative is messy, but the data is starting to show a very specific pattern.
And that pattern is exactly what we need to unpack. I mean, you can't spin bad math in an earnings report. And conversely, you really shouldn't ignore when the foundational math of a multi-billion-dollar business actually starts to bend in a positive direction.
Especially after years of stagnation.
Right. The stakes here are enormous. VFC has been battling massive debt loads, shifting wholesale dynamics, and serious brand fatigue.
So let's transition directly into the cold, hard data from the fourth quarter. If this turnaround is real, it has to show up in the top line first.
Absolutely.
And looking at the Q4 numbers, the top line is finally showing a pulse. Revenue for the quarter hit $2.2 billion.
Which is big.
Yeah, that represents a 3% increase year over year. Now, to contextualize why Wall Street paid attention to this, management's own guidance, their internal expectation broadcasted to the street, was that revenue would be flat, or maybe up 2% in an optimistic scenario.
So they clear their own internal bar, which is the first positive signal. But, the broader context of that 3% growth is what makes this a fundamentally interesting moment for the stock.
How so?
Well, this marks VFC's strongest revenue performance in 3 years. For the past 36 months, investors holding this stock have basically been enduring a financial winter.
Oh, absolutely brutal.
Yeah. They've watched this legacy giant tread water, lose market share, and in some quarters, just actively hemorrhage cash.
It's the difference between trying to stop the bleeding and actually starting physical therapy. Hitting $2.2 billion isn't like a hyper-growth tech number, I get that.
No, great.
But for a legacy apparel conglomerate right in the messy middle of a structural turnaround, breaking a 3-year streak of stagnation fundamentally changes the conversation in the boardroom. You stop asking, well, how do we survive? And you start asking, how do we allocate capital for growth?
Exactly. The psychological shift is massive, but it's the mathematical shift that investors care about. Which brings us to the bottom line, right? The earnings per share, or EPS.
Right, let's get into the EPS.
So adjusted ETS for Q4 came in at exactly $0. Break even. Now, I know break even doesn't sound like a victory lap on the surface.
I'll actually push back on that right now because looking at these numbers, break even doesn't scream victory to me at all. It sounds like barely keeping your head above water. Why were the analysts on the call treating this $0 EPS like a legitimate win?
Because you have to look at the trajectory. You have to compare it to the exact same quarter last year where they posted a definitive loss of 14 cents per share.
Okay, so it was negative before.
Right. Moving from a structural loss where the business is actively burning through shareholder value every single quarter to a break-even point means the financial tourniquet has actually worked.
Got it.
The bleeding on the bottom line, at least for this specific reporting period, has stopped. It proves management's cost-cutting measures and pricing strategies are having a tangible effect.
Okay, that makes sense. It's about the delta, the change in direction, rather than the absolute number. Let's shift to the metric that I know retail nerds obsess over, and honestly, it's arguably the most critical health indicator in this entire report. Margins.
Oh, margins are everything here.
Right. The gross margin data for the full fiscal year 2026 came in at 55.2%. And management was very quick to note that this was an expansion of 360 basis points. Now, I know you trust the financial literacy of our listeners, but let's quickly ground this jargon.
Of course. A basis point is simply 1/100th of a percentage point.
Right.
It's just a way for Wall Street to talk about small, incremental changes without getting bogged down in decimals. So an expansion of 360 basis points means their gross margin improved by a full 3.6 percentage points.
So mechanically, for every $100 of jackets, boots, or sneakers they sell globally, they are keeping $3.60 more in gross profit than they did last year.
Right.
And that's before they even factor in the operating expenses of running the business.
Precisely. And when you are dealing with a company doing billions of dollars in volume, that 3.6% improvement is an absolute tidal wave of capital flowing back into the corporate treasury.
Wow. Yeah.
But, it's vital to deconstruct exactly how they achieved that margin expansion, though, because it reveals the brutal decisions required in a real turnaround. It wasn't just them magically selling more expensive shoes.
Right. Because looking at the transcript, about 1% of that expansion, 100 basis points, didn't come from operational brilliance at all.
No, it didn't.
It came from subtraction. They divested the Dickies brand.
Yeah, that's a classic portfolio optimization move. Dickies structurally is a workwear brand with a fundamentally lower margin profile than a premium outdoor brand like the North Face.
Makes sense.
So when you are a holding company and you chop the lowest margin asset out of your portfolio, the blended average margin of your remaining brands naturally, mathematically rises.
It's like the GPA analogy.
Oh, exactly.
If you drop your lowest grade from the semester, your overall GPA instantly improves, even if you didn't get any smarter in your other classes.
That's a perfect way to conceptualize it. But here is the critical part for investors. That divestiture only accounts for 100 basis points.
Okay.
That still leaves 260 basis points, a 2.6 percentage point margin expansion that management fought for and won through actual hardcore operational improvements.
And that is the real meat of the turnaround thesis.
Right. They're manufacturing goods more efficiently, pricing them more strategically, and discounting them less frequently.
Speaking of margins, I noticed a fascinating, almost bizarre anomaly in Q4 specifically.
Oh, the tariff thing?
Yes. On a normalized basis, their Q4 gross margin was essentially flat year over year, but their reported statutory margin spiked to 56.4%. And the driver behind this wasn't retail strategy at all. It was a $50 million net benefit from a tariff refund following a recent Supreme Court ruling.
Yeah, this is one of those incredibly nuanced moments in analyzing an earnings report where you have to separate the core business from macro legal events.
Right.
VFC had been accounting for or actively paying certain contested tariffs for years. A Supreme Court ruling comes down in their favor, and suddenly they get a $50 million windfall dropped right onto the Q4 balance sheet.
So as an investor, how do you model that? Because you can't assume the Supreme Court is going to hand them $50 million every single quarter.
You don't model it.
Yeah.
You mentally back it out when you are judging the recurring core operational health of the company. It's a one-time, non-repeating benefit.
Makes sense.
However, you also don't ignore it entirely because that $50 million is real, cold, hard cash that instantly bolsters their liquidity. And liquidity is exactly what VFC has been desperate for.
Which perfectly transitions us to the monster hiding under the bed for VFC over the last few years. The debt.
Oh, the debt was bad.
If you've been tracking this stock, the debt load was genuinely terrifying. It was an anchor dragging the valuation down. But looking at the progress in this Q4 report, I have a way to frame this for you.
Okay, let's hear it.
Looking at their balance sheet stabilization is like finally paying off a massive high-interest credit card balance while simultaneously getting a promotion at work.
That is exactly what it feels like. It is the single most important victory in this entire earnings call, far beyond the 3% revenue growth.
Right.
Let's look at the absolute numbers here because they are staggering. Their net debt dropped from an incredibly heavy $5.8 billion down to $2.7 billion.
Wow.
Yeah. They paid off more than half of their net debt, excluding their lease liabilities, in a relatively short operational window. They specifically noted paying off a massive 500 million euro maturity earlier this year.
Okay, let's connect the absolute debt reduction to the operating metrics. When you wipe out that much debt, your leverage ratio absolutely plummets. Management highlighted that their leverage ratio fell from 5.1x down to 3.1x over the course of the year. Let's break down the mechanics of the leverage ratio for the listener, because going from 5 to 3 is what management called a full turn better than last year. Why does that specific metric dictate so much of a company's reality?
Well, the leverage ratio is basically a company's financial blood pressure.
Okay.
It essentially measures how many years it would take the company to pay back all of its outstanding debt using its current operating profit, specifically its EBITDA, which is before interest, taxes, depreciation, and amortization.
So when your leverage ratio is sitting up at 5.1x, you are in the danger zone.
You are highly, highly burdened. At 5.1x, a massive portion of the cash flow you generate every single day from selling shoes and jackets isn't going into research and development. It isn't going into marketing.
It's just servicing debt.
Exactly. It is going straight out the door just to service the interest payments on your debt. You have virtually no financial agility. If a new competitor enters the market or a massive new fashion trend emerges, you don't have the spare capital to pivot and chase it. You are purely in survival mode.
Right. You are just treading water, making the minimum monthly payment on that corporate credit card.
But when you aggressively pay down the principal and drop that ratio to 3.1x, the entire physics of the business changes. You are suddenly breathing easier.
Free cash flow opens up.
Yes. The interest burden shrinks dramatically, which instantly frees up free cash flow. Management goes from playing defense to playing offense. They finally have the financial cushion to make proactive, strategic choices about where to invest in the portfolio.
All right, let's synthesize what we have so far. We've established the foundation.
Yeah.
The headline numbers beat management's own expectations.
Right.
Revenue is back to growing after a 3-year drought. Gross margins are expanding through real operational discipline. And the balance sheet is vastly healthier, with the debt load literally cut in half.
It's a solid setup.
But as an investor analyzing a holding company, the immediate next question is causality. You don't just accidentally grow a global portfolio by 3%.
Absolutely not. In a portfolio model, overall growth requires specific individual brands to pull significantly more than their own weight to offset the brands that are inevitably lagging.
And that leads us directly into the story behind the numbers. Let's break down the portfolio brand by brand, starting with the growth engines.
Let's do it.
The heavyweight champion of this quarter, without a doubt, is the North Face. It grew 7% globally, which is solid, but if you look at the Americas region, their home turf, the North Face saw a massive, explosive 16% jump in revenue.
That 16% regional growth is critical because it proves the brand's premium positioning is holding strong in a highly competitive macroeconomic environment.
Yeah.
And this wasn't just a fluke driven by an unusually cold winter or a temporary spike in heavy outerwear. Management noted the growth was broad-based across multiple categories. Soft shells and fleece were key drivers on the apparel side, which shows strong lifestyle adoption beyond just technical mountaineering gear.
But the really fascinating piece of the North Face data is their footwear division. Historically, the North Face is a jacket company in the consumer's mind. But their footwear division just delivered its 5th consecutive quarter of double-digit growth.
Penetrating the footwear market is incredibly difficult. It is dominated by legacy sneaker giants with massive R&D budgets.
True.
For the North Face to establish a legitimate growing foothold in trail running and hiking footwear as an entirely new, highly profitable revenue stream that isn't as strictly dependent on seasonal winter weather.
I want to look at how they are securing the future of that brand equity too, because they just announced a massive strategic move. The North Face just locked in a new multi-year partnership with the U.S. ski and snowboard team.
That was huge news.
Yeah, they are the official outfitters through at least 2034. That timeline is huge because it covers multiple Winter Olympics and countless World Cup events.
That sponsorship is a masterstroke in brand architecture. I mean, in the outdoor apparel space, authenticity is the only currency that matters. The consumer is highly educated. They know the difference between fashion outerwear and actual performance gear.
Right. They know if a jacket is just built to look good at a coffee shop versus built to survive an avalanche.
Exactly. And the ultimate validator of performance is the elite athlete. If a consumer sees an American Olympian standing on a podium wearing a North Face jacket, it completely cements the brand's technical credibility. It creates a psychological halo effect.
So it justifies the price point.
Totally. When that same consumer walks into a retail store 3 months later, they don't blink at paying $400 for a winter parka because the brand has proven its worth at the absolute highest level of human performance. It is a long-term investment in premium pricing power.
Moving across the portfolio, let's look at another major heritage player, Timberland. They posted 2% growth. Now, on paper, 2% doesn't sound explosive, especially compared to the North Face.
It doesn't sound explosive, but it is incredibly valuable in the context of a turnaround. This is Timberland's 6th consecutive quarter of growth. It represents steady, reliable, compounding momentum.
Right.
You need a mix of explosive growth and steady cash cows in a healthy portfolio.
And the mechanics of that Timberland growth are really interesting. Management noted it's being driven heavily by their absolute icons, the classic 6-inch premium work boot and their heritage boat shoes.
Right.
They highlighted that the boat shoe category is seeing significant growth potential across all global regions, not just the traditional preppy East Coast markets.
What is highly strategic here is how they are attempting to leverage the undeniable cultural power of the footwear to completely reset their apparel business. Timberland wants to establish what they call a head-to-toe expression.
Oh.
They know you already trust them for the boots. Now, their goal is to convince you to buy the chore coat, the canvas pants, and the heavy flannel that matches the aesthetic of those boots.
It's the classic retail strategy to increase the average order value, the AOV. If you are already in the ecosystem for a $200 pair of boots, capturing another $150 in apparel from that same customer is vastly cheaper than trying to acquire a brand new customer from scratch.
Exactly. It leverages existing brand affinity to drive incremental, higher margin apparel sales.
Okay, we've talked about the steady heritage brands. Now we have to talk about the absolute rocket ship in the portfolio, Altra.
Oh, Altra is fascinating.
For listeners who aren't runners, Altra is their performance running shoe brand, known specifically for their zero-drop design, where the heel and forefoot are at the exact same distance from the ground. Altra's revenue surged an incredible 45% in Q4. For the full year, they crossed $270 million in revenue.
This is a textbook best-case scenario of how to nurture a high-growth asset within a larger corporate structure. The performance running shoe market is arguably the most fiercely contested category in footwear right now.
Oh, for sure.
You have massive incumbents and you have hypergrowth upstarts stealing massive market share.
It's a gold rush right now for specialized running shoes. And Altra is clearly capturing that momentum.
They are, and management is actively pouring fuel on that fire. They explicitly stated they are heavily increasing investments in product creation and top-of-funnel marketing for Altra. They highlighted highly successful recent franchise launches, specifically calling out the Lone Peak 9 and the Experience models.
They are really pushing it.
They are innovating rapidly in a space where technical innovation drives consumer adoption.
Here's the most potent mathematical detail about Altra from the call. They're growing at 45%, but management also noted that overall brand awareness for Altra is still incredibly low among the general public.
That combination hypergrowth combined with low brand awareness is the holy grail for a financial analyst.
Why? Walk the listener through that logic.
Yeah.
Why is low awareness actually a massive positive when you were growing at 45%?
Because it defines the total addressable market and the runway for growth. If a brand is universally known, growing it further requires incredibly expensive marketing to convince people who already decided not to buy it to change their minds.
Right.
But if a brand is growing at 45% purely on word of mouth among hardcore runners, and 90% of the general public still has no idea what it is, your customer acquisition cost remains incredibly efficient as you scale.
The ceiling is miles above where they currently are.
That's why management confidently threw out the phrase billion-dollar-plus brand over time on the call.
It's a counterbalance the portfolio desperately needs. While Timberland grows at 2%, Altra growing at 45% provides the overall blended growth rate that Wall Street demands to see in a turnaround narrative. But as with any massive holding company, you have your stars and then you have your problem child. And we have to address the elephant in the entire VF Corporation story. Vans. Vans was down 5% globally in the quarter.
Yes, the headline number for Vans remains negative.
Okay, I have to push back hard here because I read the transcript of this call multiple times. If Vans is down 5% globally this quarter, and keep in mind, for the full year prior, it was down double digits, and management is still projecting a mid-single-digit decline for the current fiscal year.
Right.
Why on earth did management sound so victorious on the call? The CEO was literally talking about the sun coming up in California and seeing tangible green shoots.
Yeah.
Why take a victory lap for a brand that is objectively mathematically shrinking?
It is a totally valid challenge. If you just look at the consolidated top-line number, the optimism seems completely disconnected from reality. To understand why management is genuinely celebrating, you have to completely deconstruct the architecture of how a brand like Vans actually generates revenue. You have to understand the fundamental tension between the wholesale channel and the DTC channel.
Let's break that down. A lot of retail investors look at revenue as just a single bucket of money. Translate the structural difference between wholesale and DTC and why they behave so differently.
Wholesale is the traditional legacy model. This is when VF Corporation sells 10,000 pairs of Vans to a massive department store or to a chain of specialty skate shops. VFC sells them at a wholesale discount.
Okay.
The department store takes on the inventory risk, puts the shoes on their physical shelves, and tries to sell them to the end consumer.
Got it. Wholesale is selling in bulk to the middleman. What about DTC?
DTC stands for direct to consumer. This is when VF Corporation sells the shoes directly to the end user, either through their own physical Vans retail stores located in malls, or directly through the Vans e-commerce website.
You completely cut out the middleman. You capture the full retail margin.
Exactly. You capture the margin, but more importantly, you capture the data. Now, here's the critical dynamic that answers your question about management's optimism. Global wholesale for Vans is severely lagging.
Right.
The department stores and the skate shops are cautious. They have too much inventory, so they are not placing large orders for new Vans. That is what is dragging the global number down by 5%. But, and this is the massive pivotal beside that the CEO is cheering about America's, DTC for Vans actually grew by 5%.
And just to establish the scale, the Americas region is their largest market by far.
Yes, the Americas region accounts for more than 50% of the total global business for Vans. And within that region, the DTC channel represents about 40% of the business.
That's substantial.
That 5% growth in America's DTC is a massive milestone because it is the first time that specific critical channel has seen positive growth in almost 4 years.
I understand it's a milestone, but why does a 5% growth in DTC outweigh a massive ongoing decline in global wholesale? Why is DTC growth the ultimate cause for celebration and a turnaround?
Think of the DTC channel as a highly sensitive, proprietary radar system for brand health. It is the ultimate leading indicator.
Okay.
When you sell through a wholesale partner, like a department store, you are blind. You don't know who bought the shoe, you don't know what else they looked at, and you only get sales data weeks or months later.
Wow, yeah.
But when you control the DTC channel, you see the consumer behavior instantly. You know exactly what specific colorway is trending on a Tuesday. You know what marketing campaign drove website traffic on a Friday.
So it's real-time cultural feedback.
Precisely. If DTC is growing, it means the end consumer fundamentally desires the physical product again. They are actively choosing to walk into a Vans store or type vans.com into their browser. The brand is regaining its cultural relevance and heat.
Okay, I see where this is going. How does that proprietary radar system connect back to the wholesale problem?
It creates a domino effect. The wholesale buyers, the executives deciding what brands to stock at major national retailers, they do not operate in a vacuum. They watch a brand's DTC trends like hawks.
Right. They want to know what's selling.
Exactly. If they see that Vans stores are packed and the website is selling out of new releases, they know the brand is hot. That gives them the confidence to pick up the phone and place massive wholesale orders for the upcoming season.
So wholesale always fundamentally lags behind DTC.
Always. The wholesale order books take time to rebuild because those buyers are risk averse. So when management looks at that 5% America's DTC growth, they aren't just seeing a slight uptick in retail sales. They are seeing the first domino fall.
I see.
They are saying, look, the consumer has returned, the brand is culturally relevant again, and therefore the massive wholesale orders will inevitably follow in the coming quarters.
That completely changes the context of the 5% decline.
Yeah.
The underlying engine is actually restarting. But I want to dig deeper. Because a brand doesn't just spontaneously regain cultural heat after 4 years of decline.
No, it takes work.
Right. It requires hardcore operational shifts behind the scenes to create the products people actually want. We mentioned the divestiture of Dickies earlier, which mathematically improved margins. But there were massive internal operational changes highlighted on this call regarding how they actually make and sell the product.
The turnaround of Vans and the broader portfolio is deeply rooted in severe operational discipline that was previously lacking. One of the most fascinating examples they provided was the implementation of AI and advanced analytics for sharper markdown strategies, specifically utilized at the North Face and Timberland.
Let's unpack that. How does AI change how you put a jacket on sale?
Well, historically, apparel markdowns are a blunt instrument. At the end of a winter season, a retailer might just broadly slash the price of all winter jackets by 30% to clear the warehouse space for spring inventory. It's a massive hit to gross margins.
Right.
What VFC is doing now is using artificial intelligence to analyze highly specific in-season data at the localized store level. They execute targeted, highly surgical markdowns.
So instead of a blanket 30% off everywhere, maybe a specific blue jacket goes on sale for 15% off in Chicago, but stays full price in Denver because the AI models predict a late season snowstorm will drive localized demand.
Exactly. It's about optimizing price elasticity in real time. Management noted this AI-driven approach resulted in a highly meaningful uplift in gross margin dollars. They're extracting the absolute maximum possible profit out of every single item of clothing before they resort to a discount.
That is brilliant margin protection. But the operational shift that absolutely staggered me, the one that I think defines the future of this company, was a detail they dropped regarding their speed to market. This directly ties back into how they are fixing Vans.
This specific data point is a total game changer for a legacy brand. You have to understand the context of apparel manufacturing.
Okay.
The traditional go-to-market cycle for a global sneaker brand is agonizingly long. It routinely takes 12 to 18 months from the moment a designer sketches a shoe to the moment that physical shoe sits on a retail shelf.
You are basically trying to predict the future a year and a half in advance.
You are. But management revealed on this call that for the fall 2025 season, Vans pulled forward entirely new products that were originally slated for fall 2026. They designed these new shoes, sourced the materials, manufactured them, and delivered them to the market in exactly 77 days.
77 days. That is roughly a third of their traditional development cycle. How is that physically possible for a massive conglomerate?
It's extremely difficult.
I mean, I understand how a nimble digital startup does that, but VSC has layers of corporate bureaucracy, global compliance, and massive physical scale. How do you compress 18 months into 2.5?
It requires a brutal, complete rewiring of your entire supply chain architecture. You can't operate sequentially anymore. You have to operate concurrently.
What does that look like?
It means you work intimately with a select group of trusted vendors, essentially giving them continuous capacity rather than bidding out individual orders. It requires incredibly precise, data-backed product briefs from the start. So there is absolutely zero time wasted on design revisions or material sampling.
And management specifically used the phrase creative confidence in design regarding this speed.
Yes, that is the cultural shift required. In a 77-day cycle, you cannot second-guess yourself. You cannot have 5 different committees review the color of the shoelaces. The designers design it, the factory makes it, and logistics ships it. It requires an immense amount of corporate trust.
Let's bring this back to the investor's perspective. What does a 77-day cycle actually mean for the financials of the business? Why is speed so intrinsically linked to profitability?
Because speed fundamentally destroys inventory risk. Under the traditional 18-month cycle, you have to guess what millions of teenagers will think is cool a year and a half from now.
Which is impossible.
Right. If you guess wrong, you manufacture millions of pairs of shoes that nobody wants. You are stuck with dead inventory that clogs your warehouses, ties up your cash, and forces you into those massive margin-destroying markdowns we just talked about.
But with a 77-day cycle, the risk profile completely inverts.
Completely. With a 77-day capability, you can manufacture a highly limited small batch of a new experimental silhouette. You drop it into your DTC channel. If it goes viral and sells out in a day, you chase that demand immediately.
Wow.
You tell the factory to spin up production, and you have a full restock back on the shelves in 2.5 months while the cultural hype is still at its absolute peak. If the initial small batch fails, you just drop the design before you commit massive capital to a full global rollout.
It is essentially adopting the agility and A/B testing mindset of a Silicon Valley software company, but applying it to the physical manufacturing of rubber and canvas.
That's a great way to put it.
It allows them to capitalize on micro trends. They collaborate with the musician, it blows up on social media, and they actually have the product available to capture the revenue before the trend dies.
That speed, combined with better product newness and sharper, culturally relevant marketing drops, is the structural foundation of the Vans turnaround. It's why DTC is growing. They are finally reconnecting with youth culture at the actual speed of youth culture.
Okay, we have thoroughly unpacked the operational mechanics. We see how the brand heat is returning to the North Face and Altra. We understand exactly why the leading indicators are flashing green in the Vans DTC data and how AI in a 77-day supply chain are fundamentally fixing the margins.
It's a lot of progress.
But as any seasoned retail investor knows, Wall Street is a forward-looking machine. The market absolutely does not pay you for what you achieved yesterday. It prices your stock based on what you promised to deliver tomorrow.
Which naturally cues the pivot to the management guidance section of the earnings call. We have to examine what they are actively promising for the upcoming fiscal year 27.
And this brings us to a massive glaring signal of corporate confidence. VFC officially reinstated their annual guidance for fiscal 27.
That was a huge moment.
Right. For a significant period during the depths of this turnaround, things were so murky and visibility into their own supply chain was so poor that management refused to even guess where the year was going to end. They pulled guidance entirely.
Pulling guidance is one of the most punishing things a management team can do to their stock price. Markets despise uncertainty more than they despise bad news.
Yeah, the market hates the unknown.
Exactly. When you tell Wall Street, look, we honestly don't know what we'll make next year, the algorithmic models instantly assume the absolute worst case scenario and the valuation collapses.
So reinstating guidance is a stake in the ground. They're putting their professional reputations on the line. They officially project that full-year revenue for fiscal 27 will be up 1% to 2%, and crucially, they project an operating margin of approximately 8%.
It is a massive psychological milestone. Reinstating guidance tells the institutional investors, we have finally stabilized the ship. We have regained visibility into our supply chain costs. We accurately understand our consumer demand curves again. We are back in the driver's seat.
It changes the whole narrative.
It removes that suffocating layer of uncertainty that the market has historically punished them for.
But, and this is a massive neon flashing but, for anyone listening to this deep dive right now, before we pop champagne over that projected 8% margin for the year, we have to look at the immediate short-term road ahead.
Yes, we do.
We have to issue a serious warning for you regarding the next quarter. Fiscal Q1 is going to look incredibly ugly.
It is going to be a highly turbulent, messy quarter on paper. If you don't understand the mechanics of it, you will likely panic when the headlines drop.
Management explicitly stated on the call that they expect a $100 million operating loss in Q1, accompanied by low single-digit revenue declines. So I have to ask the obvious glaring question.
Go for it.
We just spent 30 minutes discussing how the turnaround is real, how Vans is finding its footing, how margins are expanding. If all of that is true, why on earth is management projecting a $100 million crater in the very next quarter?
It is the most vital question of this entire analysis. If you're holding this stock or thinking of buying it, you must understand the deep mechanics of this Q1 pothole.
Break it down for us.
There are 4 factual, highly specific reasons for this Q1 dip that management laid out on the call. 2 are internal operational decisions, and 2 are external macro headwinds.
Okay, let's unpack them sequentially. What is reason number 1 for the $100 million loss?
Reason number 1 is wholesale timing shifts. We discussed the difference between wholesale and DTC earlier. Well, in the previous quarter, Q4, the demand from VFC's wholesale partners was actually surprisingly robust.
Which sounds like a good thing.
It is. It was so strong, in fact, that those retailers requested to receive their products early. They essentially pulled Q1 wholesale revenue forward into Q4 of the previous year.
Let me make sure I had this straight. Because the retailers wanted the product faster, VFC shipped it earlier, meaning the revenue was legally recognized in Q4 instead of Q1.
Right.
So Q4 looked artificially slightly better than it should have, and Q1 looks artificially slightly worse, simply because the sales shifted across an arbitrary line on a financial calendar.
Exactly. It's an accounting reality, not a business failure. Management noted this timing shift accounted for about a 2% negative swing in Vans' Q1 projections and also heavily impacted the North Face's expected Q1 revenue.
Oh, wow.
When you normalize the data and smooth out that timing shift, the underlying growth trend of the actual consumer demand is stable. But on a reported statutory basis, Q1 revenue will look weak because millions of dollars of sales already happened a few weeks prior in Q4.
Okay, that makes complete logistical sense. It's a timing illusion. What is reason number 2?
Reason number 2 is deliberate active investment. Management is not sitting on their hands trying to merely save their way to prosperity. They are heavily, aggressively investing in top-of-funnel marketing for Altra. As we establish, Altra is growing at 45% and needs that marketing fuel right now to capture permanent market share while the iron is hot. They are also aggressively investing capital into upgrading their DTC digital capabilities across all brands.
I noticed that. But why does investing in marketing cause such a catastrophic $100 million loss, specifically in Q1? Don't they invest in marketing all year?
They do, but it's an issue of seasonality and scale. Historically, for outdoor and apparel brands, Q1 is their smallest, quietest revenue quarter of the entire year. It's the dead zone between spring and back to school. When you inject massive fixed marketing investments into your lowest revenue quarter, those expenses take a disproportionately enormous bite out of your operating profit margin for that specific 3-month window.
So they are willingly taking a severe financial hit on the chin right now in Q1 to build the brand awareness and digital foundation required for the highly profitable back-to-school and winter holiday quarters later in the year.
Exactly.
Is a strategic allocation of capital, not a structural failure of the business model.
Yeah, correct. They are sacrificing Q1 optics for full-year dominance. Which brings us to the external factors. The third reason for the Q1 weakness, and this is entirely outside of their direct control, geopolitical macro headwinds.
And as always on Talk Tickers, we need to navigate this carefully. We stick strictly to the business mechanics and the financial implications without endorsing any political viewpoints. Management identified 2 massive global forces that will act as a serious drag on their numbers. First, potential incoming tariffs.
Yes, management is actively modeling their guidance around a potential significant step up in international tariffs projected to take effect in mid-July. They were very transparent on the call, projecting that these new tariffs will have roughly a $70 to $80 million negative impact in the back half of the year on their gross margins.
Now, a $70 million hit straight to the gross margin sounds completely devastating to a turnaround plan. How does a management team deal with a sudden legislative tax like that? Do they just absorb the loss and miss their 8% margin goal?
No, they don't just absorb it. And this is where that operational discipline we highlighted earlier truly flexes its muscles. They have seen this tariff legislation coming, and they have been actively mitigating the risk for the past 12 months. They are executing what they call a rebalancing of their sourcing footprint.
Explain the physical mechanics of that. Rebalancing a footprint sounds like corporate jargon. What does it actually mean on the ground?
It means moving the physical manufacturing of your products out of the geopolitical regions affected by the new tariffs and into regions that aren't, and that is incredibly difficult.
I can imagine.
It requires breaking existing vendor contracts. It requires finding brand new factory floors in different countries that have the exact same specialized looming, stitching, and waterproofing capabilities. You have to physically reroute the supply chains of your raw materials, the cotton, the zippers, the Gore-Tex, to these new factories. You have to establish entirely new quality control teams.
It is a monumental logistical undertaking. You are essentially rewiring the global map of where your clothes are made while the business is still running.
Exactly. They are also actively negotiating with their remaining manufacturing partners to share the burden of the increased costs, and they are optimizing their shipping routes to reduce exposure.
Wow.
The chief operating officer was highly explicit on the call, despite facing this massive $70 to $80 million gross headwind. Their mitigation strategies are so effective that they still feel entirely confident they can absorb the blow and hit that 8% operating margin target for the full year.
Which honestly is an incredible flex of supply chain mastery if they can actually pull it off.
That's right.
Now, what is the fourth reason? The second macro headwind impacting Q1.
The global supply chain disruptions stemming from the ongoing conflict in the Middle East. Management stated this disruption is expected to negatively impact their total global revenue by about 100 basis points, which is a full 1% drag on top-line growth.
And again, keeping this strictly to the business implications, how exactly does a regional conflict in the Middle East shave 1% off the top line of an apparel company headquartered in Denver, Colorado? Walk us through the physical chain of events.
It impacts the business through 2 distinct vectors. First, there are the direct, localized operational impacts. VFC has wholesale partners and retail operations within that specific geographic region and surrounding areas. Naturally, consumer demand and retail operations are suppressed during a conflict. That revenue simply disappears.
Right.
Second, and much more broadly, it severely disrupts global shipping lanes, specifically the transit routes through the Red Sea and the Suez Canal.
Right. The shipping containers full of shoes and jackets can't take the direct route from Asian factories to European markets.
Exactly. When commercial freight has to be rerouted around conflict zones, often taking the massive detour around the Cape of Good Hope at the bottom of Africa, transit times increase by worths.
And time is money.
It is. When transit times increase, the global supply of available shipping containers drops, which causes the spot price of ocean freight to wildly fluctuate and spike. You are burning more fuel, paying higher insurance premiums, and waiting longer to get your product to the shelf. It adds massive friction and cost to the entire European and Asian supply chain.
It is a stark reminder for retail investors that these holding companies do not operate in a financial vacuum. A disruption on a shipping lane halfway across the world eventually, inevitably, shows up on a balance sheet in Colorado, eating into the gross margin of a $60 pair of canvas sneakers.
It absolutely does. But again, to management's credit, they have fully factored this 100 basis point hit into their public guidance. They are projecting 1% to 2% total revenue growth for the year, even with that massive logistical headwind dragging them down.
And I noticed in the transcript, there is one tiny, bizarre mathematical quirk of the calendar that actually helps them offset a fraction of that macro pain, right? The 53rd week.
Yes, it's a fun quirk of retail accounting. Fiscal year 27 happens to have 53 weeks instead of the standard 52 weeks. That single extra week of retail sales will provide about a 0.5 percentage point benefit to the total top line, which somewhat smooths out the regional revenue hits they are taking.
Okay, so if we zoom out from the immediate terror of the Q1 pothole, we understand the wholesale timing shifts, the heavy strategic investments in Altra, the massive tariff mitigation, and the shipping lane disruptions.
Right.
When you look past Q1 to the medium-term goal, management is absolutely steadfast in their projection. Despite the turbulence, they are formally committing to an exit run rate of a 10% operating margin and bringing their debt leverage below 2.5x by fiscal year 28.
And we need to clarify that specific phrase, exit run rate, because it is vital for modeling the stock. They had to explicitly clarify this for the analysts on the call.
What does it mean?
They do not mean that the entirety of fiscal year 2028 will average a 10% margin. They mean that by the time they exit that fiscal year, by the fourth quarter of 2028, the business will be operating on a trajectory that yields a 10% margin. It means by the time you hit 2029, you are looking at a fundamentally different, highly optimized, highly profitable company.
So, sifting through all of this data, the bullish long-term guidance of a 10% margin, the bearish short-term reality of a $100 million loss in Q1, the explosive 45% growth of Altra, the slow, methodical stabilization of Vans DTC, and the geopolitical maneuvering, we need to synthesize this into a concrete takeaway for you. It is time for the bottom line.
This is where we have to synthesize the noise and take a definitive, actionable position based purely on the data.
And our stance at Talk Tickers is this. This Q4 earnings call is a highly credible, cautiously bullish signal for the retail investor. Let's be clear about what this is not. It is not a meme stock rocket ship. It is not an overnight cinematic miracle. But management is executing a textbook, deeply operational turnaround.
They are doing exactly methodically what they promised Wall Street they would do 2 years ago. They stabilized the balance sheet by cutting their massive debt load in half, giving them breathing room.
Yeah, that was huge.
They killed their bad margin-destroying inventory habits by utilizing AI and radically speeding up their supply chain to 77 days. And most importantly, they got the single most crucial metric in the entire portfolio, Vans America's DTC, back into positive growth territory, proving the brand is not dead.
So let's break this down into actionable advice for you, the listener, right now, depending on your current portfolio strategy. Let's start with the current shareholders.
If you are currently holding VFC stock and you have suffered through the last 3 years, the data strongly suggests you hold tight. The core investment thesis of the turnaround is actively playing out in front of you.
Right.
The leverage ratio is down to 3.1x. The gross margins are up 360 basis points. The company generated $405 million in normalized free cash flow this year. They are not a distressed asset. They are actively generating cash while restructuring. You endure the pain to reap the reward. Let the management team finish the job.
Now, what if you are a listener who doesn't currently own the stock, But you are looking at this turnaround data. You see the 10% margin target, and you are considering buying in. What is the tactical play here, considering everything we just discussed about Q1?
If you are considering initiating a position, you must be highly tactical. Because management has explicitly and loudly warned that Q1 will feature a $100 million operating loss, there is a very high probability that the broader algorithmic market will react poorly to that specific quarterly print when the press release drops in a few months.
Explain that dynamic. Why would the market panic if management already warned them it was coming?
Because a massive portion of daily trading volume is driven by quantitative algorithms and institutional models that scrape headlines. Those algorithms do not read the deep nuance of wholesale timing shifts, pulled forward revenue, and strategic Q1 marketing investments.
Right.
They just scrape the headline that says VFC posts 100 million loss and trigger automated sell orders. The stock will likely experience a short-term dip.
Exactly. The algorithms see the red ink and dump the stock. But you, the informed retail investor listening to this deep dive, know exactly why that dip is happening. You know it's a timing illusion and a strategic investment phase.
Precisely. That algorithmic Q1 dip could present a highly strategic, discounted entry point for a stock that is mathematically projected to expand its margins to 8% for the full year and hit a 10% run rate by FY28. You buy the structural, automated fear, knowing the operational reality.
You buy the dip when the market panics over pothole that the company explicitly mapped out months in advance. It is classic retail arbitrage. You are trading on the deep context that the algorithmic headlines fundamentally miss.
It is the entire purpose of digging into these grilling earnings calls. The true value for a retail investor is always found in the context.
Okay, we have covered an immense amount of ground today. We have dissected the financials, the AI margin optimization, the 77-day supply chains, the geopolitics of tariffs and shipping lanes, and the actionable strategy for your portfolio. But before we wrap up this deep dive, I want to leave you, the listener, with a final provocative concept to mull over. Something that builds on everything we just discussed, but points toward the macro future of the entire apparel industry.
And I think this concept comes back to that operational miracle we discussed earlier with Vans.
It does. Management boasted about fundamentally rewiring their manufacturing to cut the Vans product lifecycle down to just 77 days. They identified a trend, designed a shoe, sourced it, and got it onto physical shelves in 2.5 months.
It's incredible.
Now, historically, we are entirely used to seeing that kind of hyper-fast speed from digital-first, ultra-cheap competitors. Companies that churn out disposable, low-quality clothing based entirely on fleeting social media trends.
Right. The traditional fast fashion model strictly relies on speed and ultra-low manufacturing costs, inherently sacrificing product quality and long-term brand equity in the process. You wear it twice, it falls apart, you buy another one.
But VF Corporation is the antithesis of a disposable brand company. They own the North Face. They own Timberland. These are legendary heritage brands that command massive premium pricing power, specifically because they are built on decades of authenticity, durability, and quality.
Exactly.
So here is the thought to ponder as you watch this stock. If a legacy behemoth like VF Corporation can successfully adapt the hyperspeed 77-day cycle of a fast fashion competitor while simultaneously maintaining the premium $100 plus pricing power and quality of a heritage brand, could this hybrid model become the new gold standard for the entire global sector?
A premium heritage brand moving at the actual speed of the internet, it fundamentally changes the economics of the apparel business.
It is the holy grail of retail. You achieve premium gross margins with virtually zero inventory risk because you are reacting to culture in real time. If VFC actually pulls that operational pivot off at a global scale across all their brands, it won't just successfully turn around their stock valuation, it will force every single legacy competitor in the world to completely rewrite their supply chain playbook or face extinction.
It proves that the mountain isn't just capable of moving, it might actually be learning how to sprint.
And that is exactly where we will leave it for today. This has been your highly actionable, data-forward, Talk Tickers deep dive into VF Corporation. Keep your eyes on that upcoming Q1 algorithmic print. Watch the data on that 77-day supply chain capability, and we will see you on the next deep dive.